The software industry is a very attractive industry to invest in, and it has been for quite a few years now. You could say, though, that the peak exuberance of this was November-December 2021. The industry, however, is very fear and greed defined, and that goes back even to the dot-com days. Investing in software companies, though, really took off around 2010-2011, when a famous article was published in the Wall Street Journal by Mark Anderson. The title of this was "Why Software is Eating the World." The arguments put forward in the article said that the most valuable companies in the world going forward will be software companies. Now, 10 years down the line, I think we can say that software really did eat the world, and he was correct. Just looking at US stocks, otherwise my comparison wouldn't really work because you'd have Saudi Aramco in there. The ranking 2010 had the most valuable company as ExxonMobil. Then you had Microsoft, Apple, Walmart, and Berkshire Hathaway. So 2 out of 5 top were software and tech companies. Now, you have Apple as the most valuable company. Then you have Microsoft, Alphabet, Amazon, and Tesla. You could argue that all 5 of these are software and tech companies. Additionally, at the time that the article was released, it was arguing that many of the software companies have a similar PE ratio as the wider market, and they should be valued higher than that. Today, with the recent drawdown in tech, we're in a similar situation. Software companies are in a great position to continue to show high earnings in a high inflation society, seeing as the cost of materials usually used aren't that big. The 5 rules for successful stock investing was first published in 2007, and as such, it's a bit dated on the subject of software investing, but it still has a few good points. One of the major drawbacks of the software industry is that it's highly competitive due to the low barriers of entry and the startup costs. There are, however, a few quite strong moats that can make a great software company. The first moat to look for is high switching costs and barriers. High switching costs does not always refer to the finances involved, but it also refers to the difficulty and the time needed to invest in it. Take the Android versus iOS discussion. At this point, if you've had your operating system for a few years, you're likely to keep it. The hassle of changing it is way too much. The second moat is network effects. Network effects is usually something you hear now when you're referring to cryptocurrencies, but it very much relates to software companies as well. In simple terms, a network effect works by making the network more valuable with each new user in it. The financials to look at are similar to the standard ones in the book. However, there are some additional ones that if you can find them, they're very useful. This is not in the book though, so this one is on me. What's worth noting though is that these are more relevant to B2B software companies. The first thing to look at is the customer acquisition costs. This looks at how much it costs to acquire a new customer. It's calculated the following way. Sales and marketing expense plus the setup costs minus the setup revenue divided by the number of customers acquired in the period. Tracking the changes in this over a longer period of time gives you a good understanding of how efficiently the company is acquiring new customers. The second one is the annual revenue per customer. This is calculated by taking the revenue from customers during the period divided by the number of customers during the period. In general, I'm not a fan of averages, and there are some software companies where you have 2 or 3 customers that make up the bulk of the revenue. I think Palantir is one of these companies. But it's worth to keep an understanding of this and keep track of what's changing and what's not. There are a few things that we should pay extra attention to with software companies, and they are the following. First, increasing sales. Sales should be growing, and we should know how and why. Are there more paying customers, or are existing customers paying more? A long track record. Given that the barriers of entry are usually very small, having a software company that's been around a long time is a good sign. Increasing profit margins. Software companies should be able to increase their margins as time goes on. Loyal and large customer bases. Customers that stay with the company is a good sign that the product is doing good. Great management. We've been through how to look at management before, and this is particularly true in software companies, given that the assets are mostly the people in these. Be wary of huge stock compensations. While it might be used to attract talent, it can often be detrimental to investors. Software companies can have a huge growth perspective, but the industry is so competitive that it's worth going through the historical performance and going with an established software provider instead of a possible unicorn. Thank you for listening, and I hope you learned something today.